companies. As a result, they had to come up with around $9 billion to pay out these withdrawals. But that's not all. Silvergate Bank also faced scrutiny from prosecutors who were investigating the collapse of FTX. Their attention was drawn to the fact that Silvergate Bank hosted accounts connected to Sam Bankman-Fried, the founder of FTX. To make matters worse, Silvergate Bank had all of their money tied up in bonds or lent out, so they had to borrow $4.3 billion from the Federal Home Loan Bank of San Francisco to cover these withdrawals. This move drew the attention of a group of senators in Washington, D.C., who criticized both Silvergate Bank and the Federal Reserve for their inability to identify gaps in Silvergate Bank's due diligence process. They pointed out that by taking the cash injection from FHLB, Silvergate Bank introduced crypto market risk further into the traditional banking system. To make matters worse, interest rates had gone up a lot in 2022, causing the value of bonds on Silvergate Bank's balance sheet to drop significantly. They had to sell half of their bonds and reclassify some of them as available for sale, resulting in a loss of $751.4 million during the fourth quarter of 2022. Additionally, they had to write down a $196 million investment in certain developed technology assets related to running a blockchain-based payment network. So, where did things go wrong for Silvergate Bank? It all started with the collapse of FTX, which caused a loss of faith in crypto exchanges among investors. This led to a bank run at Silvergate Bank and forced them to borrow from FHLB to cover withdrawals. On top of that, the drop in the value of bonds on their balance sheet caused them to incur significant losses. It just goes to show how interconnected the traditional banking system and the crypto market can be. Silvergate announced that it is winding down operations and liquidating. The bank's collapse was caused by crypto-related losses and crypto volatility, leading to a withdrawal of customer deposits. But what led to this event? And could it happen again? It all started in September when Silvergate was fine, despite Bitcoin loans, as most of their money was in high-quality bonds with zero risk weights. But when their deposits went out the door, they had to sell assets and realized a $1 billion net loss, leaving them in a precarious position where an additional $19 million loss would put their capital below 5%, making them no longer considered well-capitalized. Last week, Silvergate announced that they sold additional debt securities in January and February to repay the company's outstanding advances from the Federal Home Loan Bank of San Francisco. However, they also stated that they expect to record further losses related to the other-than-temporary impairment on the securities portfolio, which could negatively impact the regulatory capital ratios of the company and make them less than well-capitalized. Moreover, they're evaluating the impact of these events on their ability to continue as a going concern for the 12 months following the issuance of financial statements. This announcement caused the stock price to drop by half that day and prompted Coinbase, Galaxy, Paxos, and other crypto firms to stop accepting or initiating payments through Silvergate, further reducing deposits. Bank runs are not a new phenomenon, but they mostly belong to the distant past. The last bank run in the UK was at Northern Rock in 2007, while the one before that was over in Gurney in 1866. In the modern U.S. banking system, deposit insurance reassures retail depositors, and programs ensure that solvent banks can deal with withdrawals. Bank examiners and various regulations, such as capital requirements, help banks stay solvent. But Silvergate's customers started withdrawing their money because they were worried about the bank's solvency. Late last year, when the problem started, customers withdrew their money because crypto had collapsed. The problem was not the Bitcoin loans, but the crypto customers whose own customers no longer trusted them. Contagion from the crypto crash caused problems at Silvergate. Additionally, rising interest rates caused losses in their bond portfolio, further weakening their capital position. Recently, we saw a big sell-off in big U.S. bank stocks, which appeared to have been sparked by difficulties at Silicon Valley Bank, a small technology-focused lender. The bank revealed that it had lost roughly $1.8 billion following the sale of a portfolio of securities valued at $21 billion, which it had to sell in response to a decline in customer deposits. The losses prompted the bank to announce a share sale to shore up its capital position. The losses on the sale of the Silicon Valley Bank bond portfolio shifted investor attention to the risks that might be lurking in the huge bond portfolios held by other U.S. banks, many of which invested an influx of deposits during the coronavirus pandemic into long-dated securities that will have fallen in value as interest rates went up. In light of recent industry and regulatory developments, Silvergate has decided that an orderly wind-down of bank operations and a voluntary liquidation of the bank is the best path forward. The bank's wind-down and liquidation plan includes full repayment of all deposits. However, the collapse of Silvergate has sparked concerns about the potential for future bank runs, leading many to question whether we could see more banks collapsing in the future. Only time will tell. Thank you for watching. If you found this video informative and valuable, please consider subscribing to my channel and clicking the notification bell to stay updated on future videos. Together, let's continue to learn and stay informed about the latest developments in the world of economics.